If you earn between £100,000 and £125,140 in the UK, you are quietly handing over 60 pence of every extra pound you earn to HMRC. And the truly wild part is that this rate appears nowhere on your payslip, nowhere on your tax code, and HMRC will never once write you a letter telling you it's happening. You just lose it, silently. Today, I want to walk you through exactly how this works, why it exists, who it's hitting right now, and most importantly, what you can actually do about it. Because the standard advice is changing fast, and most people haven't caught up yet. A lot of people vaguely know there's something weird about earning over £100,000, but the full picture is genuinely shocking when you lay it all out. So let's do that. Here's the basic mechanic. In the UK, everyone gets a personal allowance. That's the chunk of income you earn completely tax-free, currently £12,570. But once your income crosses £100,000, HMRC starts clawing that allowance back. For every £2 you earn above £100,000, you lose £1 of your personal allowance. So by the time you reach £125,140, your personal allowance has been completely wiped out. You're paying tax on income that was previously tax-free, and you're doing it while also paying the 40% higher rate on new earnings. Stack those two things together, and you get an effective marginal rate of 60%. That's not a tax bracket. It's a mathematical consequence of two rules colliding at the same time, which is exactly why it never shows up anywhere obvious. Now here's the thing that makes this genuinely outrageous. That £100,000 threshold was introduced in April 2010. It was designed to catch the very highest earners, the top fraction of a percent. But it has never moved. Not once in 15 years. Meanwhile, inflation has done what inflation does. In real terms, £100,000 in 2010 is roughly equivalent to £150,000 today. So the trap hasn't moved, but the cost of living has, which means it's been creeping down the income ladder and catching people who were never the intended target. We're talking about senior nurses, junior consultants, experienced teachers who've moved into leadership, engineers, mid-level lawyers, people who work hard, have good careers, and are nowhere near what most people would consider the very rich. In 2017 to 18, around 300,000 people were caught in this band. By 2025 to 26, that number hit roughly 725,000. And the projections suggest that by 2029, it will be closer to 2.3 million. The government has committed to keeping thresholds frozen until at least 2031. So this isn't going away, it's getting bigger. But the income tax side is actually just the beginning, and this is where it starts to get really brutal. Crossing £100,000 doesn't just trigger the personal allowance taper. It simultaneously triggers three separate losses at once. The first is tax-free childcare, a government scheme worth up to £2,000 per child per year, gone the moment either parent earns over £100,000. The second is the extra 30 hours of free childcare for children from 9 months old up to school age, and since September 2025, that expansion covers babies as young as 9 months. So crossing £100,000 now costs families with young children far more than it used to, which drops back to the standard 15 hours. And the third is the personal allowance taper we just talked about. All three hit at the same time, not gradually, not phased. The moment you cross £100,000 by even £1, all three kick in simultaneously. The Institute for Fiscal Studies actually ran the numbers on this, and what they found was extraordinary. A parent with a 1-year-old and a 2-year-old in England, paying typical London childcare rates for 50 hours a week, could see their disposable income fall by £20,000 if their salary crosses £100,000. Meaning a parent earning £130,000 a year could genuinely be worse off in terms of what they actually take home than a parent earning £99,900. That's not a rounding error. That's a £30,000 salary difference going backwards in real terms. And the cruel irony is that a couple where both partners earn £90,000 each, so £180,000 combined, faces none of these penalties, because the rules are applied per individual, not per household. Two people on £180,000 combined keep everything. One person on £105,000 loses it all. So, if you're watching this and you're in that band or heading towards it, the question is obviously, what can you actually do? The standard answer for years has been salary sacrifice into your pension. And it still works, for now. The logic is straightforward. If you can reduce your adjusted net income below £100,000, you step outside the trap entirely. So if you earn £110,000, you'd need to sacrifice £10,000 into your pension via your employer's salary sacrifice scheme. That £10,000 never touches your adjusted income. It goes straight into your pension before the calculation happens. You keep your personal allowance, you keep your childcare entitlements, and you avoid the 60% effective rate. For someone with children, the combined benefit of doing this can be worth well over £10,000 in a single year. It's one of the most efficient things you can do with money in the UK tax system right now. But, and this is something almost nobody is talking about yet, that escape hatch is being narrowed. In the 2025 autumn budget, it was announced that the national insurance exemption on pension contributions made via salary sacrifice will be capped at £2,000 per tax year from April 2029. To be clear, this is not a cap on how much you can contribute to your pension. You can still salary sacrifice far above £2,000, and you still get full income tax relief on all of it. What changes is that contributions above £2,000 will no longer be entirely free of national insurance. Right now, there's no specific cap on the NI relief beyond the broader annual allowance. From 2029, that changes. For people sacrificing large amounts to stay below £100,000, the strategy still works to protect your personal allowance. It just becomes slightly less generous in terms of the NI saving above that threshold. Which means anyone currently relying on this strategy to stay below £100,000 needs to be thinking about whether it still works for them in 4 years' time, and what alternatives exist. The window is still open, but it won't stay this wide forever. There's also a version of this trap that almost nobody covers, and I think it's one of the most overlooked stories in UK personal finance right now. In 2024 to 25, 77,000 people aged over 66 were caught in the 60% trap. That's up 13% on the previous year, and up 126% since 2020 to 21. Pensioners. People who have finished working, drawing on their private pensions, investment income, or defined benefit scheme payouts, and finding themselves pulled into this band with essentially no salary sacrifice tools available to escape it. You can't salary sacrifice a pension you're already drawing. The strategies that work for employed people simply don't apply in the same way, and the number of retirees being caught is growing fast. If you're approaching retirement with a significant pension pot or a generous DB scheme, this is something you need to plan around before you start drawing, not after. And if you're in Scotland, the numbers are even more stark. Scotland has its own income tax bands, and income between £75,000 and £1 and £125,140 falls into the advanced rate band at 45%. The effective marginal rate for income between £100,000 and £125,140 in Scotland isn't 60%. It's 69.5%. That's the Scottish advanced rate income tax on the new earnings, the lost allowance being taxed, plus national insurance on top. Scottish professionals in this band keep just 30.5 pence of every extra pound they earn. To put that in context, that's a higher effective marginal rate than the top rate in most Scandinavian countries, which are generally held up as the gold standard for high-tax economies. It's one of the highest effective marginal rates anywhere in the developed world, and it barely gets a mention. And then there's one more layer that I want to flag because it affects a huge number of people who are right in the thick of their careers. For graduates still repaying student loans, anyone who started university after 2012 is on Plan 2, with a 9% repayment rate above the repayment threshold. The effective marginal rate in this band doesn't stop at 60%. It goes to 69%. If you're on the Scottish rates, it can hit 76%. We're talking about junior doctors, newly qualified lawyers, engineers, consultants, people in their 30s, doing well, working hard, and quietly losing nearly 3/4 of every extra pound they earn. The student loan system was sold as a graduate contribution. In this income band, it functions more like an additional tax that compounds on top of an already punishing effective rate. So let's bring this together, because I think the full picture here is genuinely important. What started as a targeted measure to tax the very wealthiest has, through 15 years of frozen thresholds and inflation, become a trap that's catching hundreds of thousands of ordinary professionals. It's invisible on your payslip. It hits you in 3 places simultaneously the moment you cross the line. It penalizes single-income households far more harshly than dual-income ones on much higher combined salaries. It's catching pensioners who have no obvious way out. And the main escape route is being made less generous from 2029. The government has committed to keeping the freeze in place until 2031, so the number of people affected is only going one direction. If you're in this band right now, the most important thing you can do is model your actual position, your adjusted net income, not your gross salary, and figure out whether salary sacrifice gets you below £100,000 before the rules change. If you have children in childcare, the maths on doing this is almost certainly compelling. If you're approaching retirement with a large pension, you want to be planning your drawdown strategy before you're in the trap, not after. If this was useful and you want to go deeper on how salary sacrifice actually works in practice, or how pension planning interacts with the annual allowance, I've got videos on both of those that are worth watching next. And if you know someone who earns around this level and has no idea this is happening to them, and statistically, most people in this band don't, share this with them, because this is exactly the kind of thing that costs people thousands of pounds a year simply because nobody told them. Drop a comment below if you've been caught in this trap, or if you've found a way to navigate it, because those conversations are genuinely useful for everyone watching. The 60% trap is real, it's growing, and it's invisible by design. But now you know it's there.